Hello, DGRE partners and future DGRE partners. Welcome to the February Darwin German Real Estate Meeting. My name is Brian Holly. I am president of Darcorp Management Group and will be your host tonight. Also joining me will be Darwin, the entire DGRE team, and a special guest whom I will introduce in just a few minutes. Now, we certainly wish we could be with you in person, but we're thrilled that we have the technology to keep our family of partners updated. These monthly meetings are meant to not only keep you up to date on your investments and answer your questions, but we are also constantly searching for ways to provide our family of partners with material and content relevant to real estate investing. And tonight, we certainly have a very relevant and very timely topic, and that is taxes. First up tonight, we're going to start with our guest speaker, Nate Roberts. Nate is a CPA with Lifetime Tax Advisors and has graciously offered his time and expertise to provide some general information about advantages of investing in real estate. Nate brings a wealth of knowledge and experience, and Nate is also a passive real estate investor, so he knows what your goals are and understands what you're after. Now, you will have an opportunity at the end of Nate's presentation to ask some general questions about his presentation, but please understand that Nate cannot offer tax advice and the presentation is meant to be educational in nature. Then Darwin will join us and will provide an update on the two opportunities that are currently available. That'd be Village Condos and Blue Tahoe. I then have the envious task of sharing some exciting news to you about some DGRE portfolio distributions. So please stay with us for an update about your mailbox money checks, which we all love to hear. We will then finish up with a Q&A session for the DGRE team. Now feel free to type in your questions for Nate during his presentation, and he will address as many as he can. You then can type in any questions that you have for the DGRE team as Darwin is providing his updates. So without any further delays, let's get started with our guest speaker and welcome our guest speaker for the evening, and welcome Nate Roberts. So Nate, I'll let you take control of the screen.
All right. Well, I appreciate you letting me come here and start talking about taxes. One thing I love about real estate is most of the time when you're a tax guy, nobody wants to talk to you. But when it comes down to real estate, for some reason, I suddenly become a very popular person. So I'm pulling up my screen here right now. Can I switch this over to me? Here we go. Show my screen, and here we go. All right, so let's talk some real estate tax. As we mentioned, this is for educational purposes. I'm going to hit that here in a second. But I'm invested in real estate, and so I know where people get interested in this. I know of different ways that people like to save money, and it just makes it fun to have this conversation. So here's me. I am a partner at Lifetime Tax. I'm a CPA here in the state of Texas. We're not a CPA firm. Really what that means is I can't do audits, reviews, and compilations, but I can still do tax work. And that's really the main thing I want to be able to do is the tax consulting anyhow. So this is for educational purposes only. It's generalized information. Everybody's as unique as their fingerprint. So one of the things to keep in mind is that depending on your facts and your circumstances, this may or may not apply to you. But this may just give you some good questions to ask. So when we're talking about real estate, first thing to keep in mind is, as an investor, we're talking about passive income. There's 4 types, and there's always been ordinary, investment, and passive income. And we've got kind of a quasi 4th bucket now called qualified business income. But really what we're going to focus on tonight is the passive real estate income. Just as a general rule, pretty much anything that is a rental activity is going to be deemed as a passive activity by the IRS. And the thing that gets really tricky sometimes is passive losses can only be offset by their passive income. So if you got W-2 wages, we've got to figure out other ways to take that rental. If you got rental losses, there are other ways to move that, but that's not what we're hitting tonight. But there's lots of different ways to take advantage of what's going on in real estate. So one of the questions that people really get interested in is, can I cash flow this thing? And how? And if so, shouldn't I also be picking up some income tax? And the reality is, at some point, yes, but let's kind of walk through what that looks like. So we created this slide just to make it a little bit easier for people to understand how this works. So let's just take a very simple example. Property is making about $1 million a year in rental income, got $900,000 in rental expenses. From a net cash flow standpoint, we've got $100,000. And let's just say that we want to leave $50,000 in there. We want to be able to distribute out $50,000. Most people are thinking, well, doesn't that mean that I'm picking up $50,000 in income for tax purposes? And the answer is not yet. So on the other side is where we're bringing in the taxable income. Still taking that same $1 million of income, still deducting out $900,000 of rental expenses, still have that same net cash flow of $100,000, but we also get to do something called depreciation. So we bought a building, it's being used, and we get to take some of the wear and tear on that building and deduct it as well. So even though we have a net $100,000 in our pocket, for tax purposes, we have a $100,000 tax loss. And this is obviously based on some very, very high level simplified, very oversimplified assumptions, but in general, can you be getting cash out of something and not be picking up income tax? Yes. At some point that all kind of at some point that kind of starts to catch up with you, but that's where we kind of get into what does the game look like as you're getting into this more and more. So depreciation is a reduction in the value of the asset, and I'll talk about that a little bit down towards the end. Tonight, ignore this real estate professional. That's a completely different conversation. But everybody that's on this call that's an investor, it's probably going to fall into this middle passive investor with some passive income, or if you're a first timer, you may be a passive investor without any passive income. But we're building off of that same initial slide, and this is just assuming you own about 10%. You're getting a flow through of all the income, 10% of the income, 10% of the expenses, 10% of the depreciation, and you've got $10,000 taxable income or loss. And if you got $5,000 of passive income, you just offset it. So, and then you've got another $5,000 that you get to use somewhere down the road. If you're a passive investor, you don't have any passive income to offset it, so you got $10,000 that sometime down the road you'll get a chance to use. But this is where the power of that real estate and the power of these suspended losses kind of comes into play. Is first deal, you may just have losses and you're thinking, when do I get to use this? Well, when it starts to make some money and you get into the next deal, you're still not paying taxes because you're using passive losses off of something else. Now, another question we tend to get is a refi taxable? And so, in general, it usually isn't. Now, there's going to be some complicated tax rules. You're going to need to sit down with your tax person, figure out how this works. But in your particular situation, but returns of capital, which is what you're getting when you're getting money out of the partnership, typically aren't taxable. Down the road, and we're going to go through a K1 example here in a few minutes just to kind of help you see year one, year two, maybe connect a few more dots. But typically when you're getting money out, that's not a taxable event. Depending on the size of the returns of capital, there are times where you might get a lot more out than you put in, and then it's possible you might start picking some up. But again, that's on a case-by-case basis. But this is the way I usually try and explain this to everybody. Over the life of the partnership, you start out at zero, you got to end at zero. So you put in $100,000, you get taxable income or losses, you get distributions. At somehow it's got to come back to zero. And then this is really just taking that example just a little bit further. We're going to, let's say, we talked about that apartment complex. You start off at zero, but let's say you put in $250,000 to buy that apartment complex. Your taxable income, you got that $10,000 loss, you still got $5,000. But at the end of that first year, you're actually going to have ending capital of $235,000 because you put in $250,000, you took out $10,000 for your taxable losses, took out $5,000 of distributions, you got $235,000 left. So you can still somehow get another $235,000 out before you might be subject to some tax. Second year, let's wash, rinse, and repeat. Another $100,000 in income. This is assuming we're not bumping rents and doing other things. Another $90,000 of expenses. Another $20,000 of depreciation. Let's say we do a refi in the second year. This year we decide to distribute $125,000 from a cash out refi. Because we are just distributing and returning some of that original capital, we've gone from $235,000. We didn't put any more money in. We still have a $10,000 tax loss, have $130,000 of distributions, and our ending capital, we're still positive. We got $95,000. Now, this is where everybody's eyes are going to roll because you get this one piece of paper and you think, what does all this mean? So this is, put this all together. Here's your $10,000 loss up here. On your right side, you got part 3. When you see that $10,000 loss up there, that's your tax loss. And again, we were making money. We got money out. We got this. Sorry, this is year 2. We got a tax loss. We got $130,000 out. And then down here in this lower left-hand corner, you see the circle that says $235,000 minus $10,000 of losses, minus $130,000 of withdrawals, and ending capital of $95,000. Means we're still not getting taxed on anything. I got $130,000 out this year. So in this person's example, congratulations. You've gotten about half your money back. You still haven't picked up a dime in income. Another question that we'll get pretty frequently is, should I liquidate a retirement account? And this is a very client-specific conversation. It really just depends on where you're at. If you're in a high tax bracket, it may make some sense. If you're in a low tax bracket, maybe not. Because the person in the high tax bracket, let's just say we pull out $100,000. This is assuming tax rates stay where they're at. Highest tax rate bracket is 37%. Somebody might not be able to take it out without an excess tax. There's another 10%. So to get out $100,000, you're only going to end up after taxes with $53,000. It might make some sense. If you are in a 10% tax bracket and taking out $100,000 might cost you $10,000, you can walk away with $90,000. Or, I mean, we've even got some people who can pull that kind of money out and not get taxed at all. There's strategies that go into that. And then they get to just wash, rinse, and repeat. And they pick up all this stuff without picking it up in an IRA, because at that point you're just kicking it down the road. If tax rates go up, you can be growing it, but you're going to be paying a lot more taxes sometime in the future. So really, when you're looking at these things, the question is, how much are you going to have? What are you going to do with it? What do you think is going to happen with taxes? My theory is this is probably going to change. That's the proposal that's out there right now. How soon that's going to happen? Probably sooner rather than later. And then how much you're going to earn with the money, and what are some other ways to use the money? So just things to be keeping in mind. If you do decide to go with an IRA, just something else that you need to be aware of. Just because an IRA is a tax-deferred account doesn't mean that you don't get taxed on real estate that's held in there. So there's something called unrelated business income tax and unrelated debt financed income. This is and I know this doesn't look simple, but this is a this is kind of a summary of what that looks like. So if you got cash, you got a loan, and let's say on $1 million purchase price, half of it's financed with debt. About half the income is going to be taxed. And guess what? In an IRA, it's also taxed at very compressed rates. So anything over about $12,000, $13,000 is going to be taxed at that 37% rate. So you get taxed in the IRA, then you also get taxed when it gets pulled out. So that's kind of a quick and dirty summary of that piece for you. And some other things with rental real estate losses, up to $25,000 can be taken as a deduction against other income if you're actively participating. This doesn't apply for anything after you get over $100,000 to $150,000. Again, as investors, a lot of these pieces aren't going to come into play, but people have these questions, so just knowing when they apply to you are good to know. But active participation means you're locating and purchasing the house, rehabbing, approving tenants, constructing, doing reconstruction, just rent collection, leasing, all those sorts of things. But if you're like me and you like to write somebody else a check, let them do the work, and then you get those nice quarterly distributions, then you're not going to fall in this. You're going to fall back in that passive bucket, and this piece doesn't apply to you. A couple other items for everybody: tax avoidance. So this is something where I think people always get interested. I sold my house. Can I? How much am I going to get taxed on it? Well, if you only made $250,000 or $500,000 on it, guess what? If you meet some exceptions, you can sell that. You can do it again, and those gains you're not going to be picking up in your income. Here's one that is archaic and yet still exists in the tax code. You can rent your personal residence for up to 14 days tax-free. You still want to make sure you're, and there are caveats to that, so you got to watch out carefully, but just know that it exists. You can fund a Roth IRA, and then when you're earning that income in there, you can use it for college, first home, and then as you're distributing that money to yourself, or say you want to pass it on to your heirs, when that money comes out right now with the tax rules, it's not taxable. There are education accounts. You can get employer education assistance, and you get a deduction for that. It's not included in your income. And let's say you want to teach your kids about how to manage some money. They need a job. You can hire them and pay them a reasonable amount, and they'll pick it up in their income instead of you. And there's a certain amount that's not taxable. So this is usually where I get up and I have a little conversation with people about, if you're keeping your books, you're running a business, just know that there's a reason those things are important, because it's very easy to overlook deductions. If you're not tracking your income properly, then there may be amended returns in your future. But if you've got good books and records, this helps us, one, get things done faster, get it done more accurately, make sure we're not missing deductions, do tax planning, making sure that you're maintaining your entities properly. If the IRS knocks on your door, and I know that that's not something that anybody really looks forward to, this is how we go to them with all the support and all the records, and it just makes for a much faster, cleaner audit. And frankly, keeping your books and your records together helps you know how your business is performing. So just because there's money in the bank account doesn't mean it always is reflecting your taxes. Now, since we're into February and you're all probably going to start getting some K-1s here in the next couple of weeks, a couple things to keep in mind. Your tax return preparation is going to start with you. Keep your stuff together. Kind of take a look at last year. If you had something last year, are you going to need it this year? Because you're probably going to get a question from us if we saw it last year, we don't see it this year. It's part of our due diligence. Check your bank accounts, credit cards. Maybe you forgot about something. Those are places where a lot of times we're looking to make sure that people aren't leaving money on the table. Start your communications with your tax person early and often. The best tax planning starts on January 1st of 2021. It gets harder as we get throughout the year because we have less time to do things. And by the time we get to December 31st of 2021, we're up against the wall. And then once we're into 2022, it's pretty hard to go back and make a lot of changes for what happened in 2021. It's kind of, at that point, we're trying to rewrite history, and there aren't that many ways to do that legally. So there are things that still can be done. I call it postmortem tax planning. But if you want to get ahead of taxes, it's better to start talking with your tax person now. And just because we're putting the information into a tax return, if you don't understand it, I would suggest picking up their phone and just sitting down and saying, I don't understand this. How does this work? Because there may be something that we're not aware of, that the only way we're going to know that is as we're walking through this and as we're trying to put together the documents, we're going to know more and give you a more accurate return if we know what you've got going on. So ask the questions if something doesn't make sense. I thought I heard this. I thought this is how this is supposed to work. And sometimes there might be something going on in the background we don't know. Other times we're going to have to go through and explain this, this is how this is actually, that applies here. Here are the things that make this a little different. If we want this to apply, this is what we're going to have to change. It takes time to get it right. And especially as we're getting close to April 15th, just know that extensions are meant to help you get it right. Also make sure you're not missing deductions. And if you don't have your tax return filed by April 15th, the IRS isn't going to show up in your front door with a set of handcuffs saying, hey, you didn't get this filed by April 15th. They give us extensions for a reason. You got to make sure you got your taxes paid, or at least what you think you owe by that time. There's some potential interest and penalties afterwards. But just know that if you want to save the most in taxes, sometimes extending and making sure you're not missing things is going to help, especially as things are going on. And let's face it, 2020 is going to be a year that is going to go down. We're not going to forget it anytime soon. There's a lot of tax changes. There's a lot of stuff that just got passed on December 27th that has impacts across 2020 and 2021. But it was a 5,500 page bill, and if you've ever read War and Peace, that's a 1,225 page book. It's a little bit easier to read than the tax code. So just keep all those things in mind. And if you have specific tax questions, we're going to hit some general ones here in a second. But if you want to reach out to us, here is our contact information. You can email us at info@lifetimetA.com. And our website is www.lifetimetA.com. Everybody's going to start with Tracy. She is our practice manager, and she will get everybody directed to somebody who can help answer their question.
Thank you, Nate. Appreciate all of the great info. I'm going to take the screen back here real quickly. And again, thanks, Nate, for going over all that good information with us. I'm just going to invite everybody. You've got a chat box down at the bottom, as I said at the beginning. If you go ahead and type in your questions, then I'll go through them and read them off to Nate, and we'll answer as many of them as we have time for. The first one, Nate, let me just real quickly blow this up so I can see it. Says, is cash flow from a tick to me considered ordinary income or passive income?
Cash flow from a tick. So tick being a tenant in common, and really depends on where it's coming from, how you got it structured. But in general, if you have rental income, it's going to go through the same rules we just talked about. So it's possible it could be income, and it's going to come through. It's still going to be. It's probably going to be passive, but it'll be taxed at ordinary rates.
Okay. Next question. It says, is the depreciation expense captured as part of the K-1 that is sent to the passive investor?
Yeah. So this is it, especially if you ever have a mortgage lender. It's in that when I think you've got a copy. I think you've got control of the screen, but if you go back to that screen where I showed you the K1, your depreciation expense is going to be built into that tax income or loss on the K1. So you won't see depreciation by itself, but it's going to be a deduction that gets you to taxable income or taxable loss.
Okay, I think I'm going to know the answer to this one, but I'm going to read it to you. It says, "Hi, Nate. Is TurboTax okay to use for passive investor? I feel like I may be missing out on accurate reporting. Is there a tutorial or consultation you provide? How could we get in touch?" But I know you've already given them your contact information, so I guess I won't ask you to weigh in on a specific software. So.
Yeah, I will just say that TurboTax, TurboTax is great if you got a W-2, a 1099, and if you know what you're doing with taxes and you're pretty comfortable that you're getting the right answer, TurboTax will do it for you. Really, the best time to start trying to bring those questions to somebody that does them for a living is when you don't know that you're doing it right. If you're guessing and you're thinking, once I hit send, am I going to get a letter from the IRS? If you're not confident, it's probably time to start looking for some additional help.
Okay, next question. It says, "Nate, can you give your opinion on what Biden's tax plan will do to real estate, specifically capital gains and depreciation recapture?"
I can give you my opinion. That $5 might buy a cup of coffee at Starbucks. But I'm just of the opinion that tax rates are probably going to go up. I know what the proposal kind of looked like, but what's going to pass through Congress, yeah, we'll see when it happens. What I've learned is my crystal ball and politics just don't seem to work well together.
Okay, next question. Is there a benefit to setting up an LLC as a passive investor?
So let me speak to that one, because it's going to be a good, from a tax perspective, usually it doesn't matter. For taxes, it's usually considered a disregarded entity unless you're using it to form a separate partnership. Otherwise, it really makes no difference for us. It's actually something that the IRS has been focusing on a lot, simply because of the fact that people get that and then they use it to avoid reporting on the taxes. So now there's other penalties and changes they made to the K1 starting in 2019. But from a tax perspective, you can set one up. You don't have to. That's up to you. It's probably a better conversation with your lawyer, your estate tax planning attorney. It's really more for legal purposes, but in general for taxes, it's not going to make a difference.
Okay, I know we didn't cover a lot of 1031, but I'm going to ask just a general question here that was proposed. This is just in general, if I purchased a property using a 1031 exchange and I want to sell that, but owner finance, am I going to be taxed at that time or only after the note is paid off?
Okay, so there were a couple things that went into that one, so let me go back to, so 1031 exchange and owner financed?
Well, I think what they're saying is they bought the property under a 1031, so it's in their name as a 1031 transaction, but they're wanting to possibly sell the property, but the person that's buying it from them can't buy it outright, so they'll owner finance it. When does that become a problem tax-wise, I think is what they're asking.
Okay, well, all right. So I'm going to break this down into a couple parts, and this one gets complicated, so I'm going to try and make it quick, but hit on a couple different issues. 1031 exchange, if you roll it from one property into another, your basis is probably already lower. And then when you turn around and sell it, so a 1031 exchange allows you to defer the tax and kind of kick it down the road. If at this point you're not getting into another 1031 exchange, you're going to start getting into a taxable issue. Owner finance starts to get into a much more complicated scenario, and you might have might have some installment sales, and depending on when you're going to try and pick all those things up, there are elections, there are ways to do that, but that's going to get too detailed for this general conversation. That's probably a great time to email Tracy at the info@lifetimeta.com. And if you want to schedule a consultation, she'll work to get that set up.
Yeah, excellent, Nate. Thank you. Okay, next question. Can loss from a multifamily offset either income or capital gain on a sale for single family?
So generally, most likely. So going back to that, one of the first slides I went through, you got the ordinary income, you got the portfolio income, you got the passive income. If you are passive on the single family and passive on the multifamily, they're all in that passive bucket. So in general, if you have an income on one, you got a loss on another, they can be used to offset and reduce your overall taxable income.
Okay, a couple more here, Nate. Thank you. I think you touched on this one earlier, but just expand on it a little bit. It says, can K1 passive losses offset W2 income?
So going back to that same slide, W2 income is going to be ordinary income. It's in one bucket. K1 passive losses. If you got passive losses, you're a passive investor. The only thing that will offset is other passive income. So because W2 is ordinary and this is passive, they can't be used to offset each other.
Okay. I also know we didn't really talk about cost segregation tonight. I understand that, but just again, a general question. In general, is cost segregation of any benefit to passives considering recapture on a sale?
I actually have separate slides that I prepared for client discussions, but on your first deal, this is where it's good to kind of know what cost segregations you're getting into. So let me back up for 1 second here. In general, what a cost segregation does is you take a building and you can, on a residential, you depreciate over 27.5 years. But inside that building, you got components that might only last 5. So think carpet, think doors, think about, there might be some special electrical things that really the IRS has shorter lives, and it allows you to take those things, slice and dice them, and depreciate them faster. So as a passive on your first deal, it can benefit you to an extent, but it's going to be longer because you're going to have all those passive losses you can't use against anything. If you're on your second, third, fourth, 10th, 20th, 30th deal, at that point, it's probably going to be able to be used against other passive income somewhere else. So really where you're at in the life cycle and how you're playing the game will impact that. But where I tend to see that they're of the most benefit is when somebody's in multiple deals, because it hit on that next piece, which is also key to know. At some point, a cost segregation changes the character of that property. There's something called recapture, and unless you start figuring out ways to offset that against something else down the road, those can be picked up back up at a higher rate. So under our existing tax laws, that's something you have to be careful of with a cost segregation, is that recapture may be coming back to you instead of at long-term capital gains rates, may be coming back to you at ordinary income rates, which right now are long-term capital gains rates are 20%, ordinary is up to 37%. So you've got about a 17% delta there to keep in mind.
Thank you, Nate. Here's a good one. If I had a rent house for many years and I didn't know about depreciation, is there any way to recapture some of that?
So depending on how long you've been going, there are ways you can do that. I've seen people that haven't done it for 20 years. It's a lot more challenging to come up with something that is acceptable. But let's say it's only been 3 years. you can go back, you can actually amend a return and go back and claim that depreciation. So, and then sometimes it just really, the question is, how much benefit do you get from it? But you may want to consider it, because in the IRS's eyes, they're still going to tax you like you took it, whether you did or not. And then you've got some other conversation, you've got some other work you've got to go through if you're going through that conversation with them.
Good point. Good point. Okay, a couple more here and then we'll cut it off. But it's what is the tax rate on unrecaptured depreciation at the sale of a property?
Okay, so great question. There's actually two things. Unrecaptured depreciation. So there's what's called personal property. In tax geek speak, we call it 1245 property. That is ordinary income property. So it's going to be taxed at the same ordinary income rates that you have. So whatever you're paying on your W-2, you're going to be paying on those. So that's what I was actually alluding to on the cost segregations. There's also what's called unrecaptured 1250 property. That's more like your buildings. And that right now is going to be typically up to 25%. So it's at a lower rate, but there's actually different types of recapture.
Okay. Last one here, Nate, and again, appreciate your time. Can you carry forward passive losses to the next tax year if you cannot use them to offset passive income in the same tax year?
Yes, that's the easiest question I've gotten tonight.
Awesome.
Yeah, those losses suspend until you get to release them. And there's two ways they generally get released. One is you have other passive income, or two, if you turn around and dispose of that asset and you don't make all your money back, you've got some losses that actually can offset other income.
Okay, awesome. And if you don't mind, Nate, the last question, and I was going to cut it off, but there's only one more, so let's go ahead and take it. Is depreciation recaptured tax paid before capital gains tax at sale?
Is depreciation recaptured tax paid before capital gains tax at sale? Yes, generally they're at the same time. There's factors that impact that, but sometimes if you're going to split them apart, that's actually the first one that comes through, and then the capital gains will come after. But that gets into much more complicated scenarios that we don't want to cover tonight.
Okay. Awesome. Again, Nate, we want to thank you for your time tonight. We know this is a huge value add for our DGRE partners. Thank you again. And as I said at the beginning of the presentation, certainly encourage you to reach out to Nate and Lifetime TA for any specific needs that you have. They're wonderful partners and will help you out all they can. And Nate, again, we appreciate you being on here tonight and helping our passive investors understand what's going on with the tax law. So thank you, Nate.
Well, thanks for having us, or thanks for having me tonight. We appreciate it. Thanks, Darwin and Brian and Jeremy and everybody else are on the team. And if you need anything, feel free to reach out to us, and we'll see how we can help.
Thank you, Nate. Okay, we're going to move on. I'm going to ask Darwin to come in at this point and give us an update on two current opportunities that we have available, and that is Village Condos and Blue Tahoe. So let's start with Village Condos.
Thank you so much. As you may have heard, we've got Village Condos under contract, and we're getting ready to close on that on the 24th of this month. And it is on I-35 in Waco. It is a great deal. And we actually brought in a co-sponsor. We've got a co-sponsor program, and Ben is our co-sponsor on that. We bring him in. The way that works is somebody that wants to be a sponsor who wants to go ahead and do a deal. What we do is we bring them under our wing. We guide them through the entire process from A to Z and go through and do the whole process so that they can be a sponsor, learn all the ins and outs of the entire transaction, how to do it. They participate in asset management, and they raise a lot of the capital themselves, pretty much half of the capital. And on Village Condos, we are as far as our side of the equation, the DGRE side, we are about full on our side. We're starting a waiting list to get in on that. And Ben is currently in the process of raising money for the other half. And again, he will be involved. We are still in control. It's still the DGRE team in control, but that way he gets a peek behind the curtain. He gets to be involved and help raise money so that he can go on to his next deals. But we are virtually full. There's been some people that have put in some that said that they want to be in, and we've earmarked for them. However, like I said, we are starting on our waiting list for the money that Ben doesn't fully finish by the time we close, and that will be on the 24th of this month. A great transaction. We're projecting about a 16% per year average return, and we're very excited about that and get that one done. So if you have any questions, feel free to reach out to our investor relations team. And real quick, again, it's 1982 construction. It is on I-35, right between Dallas and Austin. It's adjacent to Baylor and brand new construction. It is not a student housing property, even though it is near Baylor. And again, great deal. And it says roll out Thursday. That's an older comment on that. We rolled that out a few weeks ago and already almost full. So any final people that want to get in on that, make sure you get on our waiting list, contact David or Garrett, and they can get you hooked up. Blue Tahoe Capital, this is one we're excited about. We're buying properties in Lake Tahoe, and I'm going to go through exactly why on the next slide, but I want to let you know, we closed on our first property a few weeks ago. First thing we did was go in there to have the roof replaced, and it's fun. We've got videos we're sharing on that where they get 4 feet of snow, and then we replace the roofs. So even roofs are being replaced during big snow events. And we also closed on that property, and the first thing we did was raise the rent 7.7%. And rents generally on the properties we're buying are extremely low. And but we bought our first one, and this is a fund. And just about every month we're going to buy a property. So we're raising money every month, about $1 million capital raise per month. And it is a growth fund, and we're projecting about a 20 to 22% overall per year return. So that is a great deal with a pref component. Go to the next slide, Brian. Here is why we like this particular business plan. First off, in Lake Tahoe, there's a building moratorium. So there's no competition being built. It's extremely difficult to build there. So the building moratorium keeps building down. There's a residential unit of use, RUU, which basically, if you want to build something, you have to tear something else down, and you can use the square footage, the coverage of that land to go ahead and build something else. So that creates a commodity in that area. So if you want to build, you have to buy somebody else's property and tear it down. So because of that, that actually costs an extra $50,000 per unit or so to be able to build any more apartments. So first off, there's none being built, and there's extremely high cost of construction to create any competing properties. Next, there's actually decreasing supply because there's a group there, a governmental agency that is buying land around Lake Tahoe and taking it off of the, let me rephrase that, it cannot be built on. They buy those properties and they put a deed restriction, tear anything down that's on it, and put a deed restriction that nothing can ever be built on that. So it's actually got decreasing supply. There's only 1,776 units in Lake Tahoe, and that's of 6 units or more. So there's already extremely limited supply. And according to the studies that they've done, there's almost 4,000 units short of their current housing needs. So that is huge with a current need of housing, building moratorium, so things can't be built. And if they were, extremely high cost of construction and decreasing supply. And then put on top of that these are all mom and pop owners because they're all smaller properties. There's not a large buying group there in Lake Tahoe. And so we can go in there and buy from mom and pop owners and we can then put it into our system and actually run it the way it is. And because of that, rents are about 30% low. So all of these things add up to a huge opportunity. We end up paying about $100,000 per unit, put about $30,000 to $40,000 per unit into them, and then we can raise rents up over 30%. So it's a beautiful business model, beautiful opportunity. We're buying about one property a month, so you can still participate in that. That is a growth fund that, like I said, we're projecting over a 20% return to partners, over 20% per year average return to those partners. So it is our growth fund. So definitely reach out. We're ready to close our next property and going ahead and raising money for that. So if you want to get involved in that one, reach out to Jeremy, David, or Garrett, and they can get you hooked up in that as well. And we're very excited about those two deals and love to have you as partners on there. And now we can go through some questions if anybody has any questions.
Yes, there are certainly some questions, but if you don't mind, I'm gonna give out some good news first.
Okay.
So, and then we'll get to questions. But as I'm doing this, I encourage you, if you have any questions, go ahead and type them in and I'll read them off, and the DGRE team will answer all of those. But again, just I get the benefit of or the privilege of giving you an update on the Darwin German Real Estate current portfolio distributions, or better known as mailbox money. So again, here you see my cartoon there. That's my rendition of Darwin driving up and handing you guys some checks off in your mailbox. Yes, some people get them ACH. We still like to refer to it as mailbox money. But here is a list of the properties that distributed in January, which is really the same list as December, except again, the exciting part is 2 new properties were added at the end of January. So if you have not, I would assume you probably already received these distributions, but if not, it's coming any day because we processed those at the end of January. The Corners and Oakview are the 2 new properties that are added to this list. I just remind you that the Corners, we just took over right at the end of September of 2020. So we've had that just over 3 months, and that's right about the timeline where we've got a really good gauge on the property and feeling really good about that. So those distributions were started, as I said, in late January. Oakview, just a reminder that we closed on Oakview December 4th of last year, of 2020. And it seems like a really quick turnaround with distributions, but remember that we had control of that property as a management company for 5 months prior to actually acquiring the property, which gave us everything we needed to know about the property to be very comfortable with our decision. And again, Oakview was added with a huge distribution as well in January. So very pleased to add those 2 properties to the list of properties. And again, congratulations to every single one of the partners that are on here. So thank you for your trust, and we'll continue to do everything we can to earn that. So I'm going to move on to question and answers, and let me start here. Just a couple of comments. Thank you, Nate. Please have more sessions like this one. Very informative. Thank you very much. Is Lake Tahoe Investment Fund open for self-directed IRA investors?
Yes, it is.
What is the current minimum investment required for the Blue Tahoe capital?
$50,000 is our current minimum. If you're looking at putting less, for example, because we're doing a raise just about every month to go ahead and take over more properties, then we'll go down to 25, hoping that you get more in there. So I'm going to change my answer to 25 on an individual deal, hoping that you invest more.
Okay, I went ahead and switched to the next slide because our question is, can we have contact to Jeremy, David, and or Garrett contact information, please? So on the screen here, you see some emails and phone numbers. So feel free to reach out. Next question, is Blue Tahoe, do all partners share in the refi income from sale of every property?
Yes, they do. Since it is a fund, it's all in the same ownership. And so every time we buy a new property, we add in that property into that same fund and add investors in. And so, yes, when there's a refinance and we decide to do the distribution of those refinance dollars. Now, again, as a growth fund, we have the option when we refinance of reinvesting that money into a new property in that same fund so that we can keep on buying in Lake Tahoe. Like I said, these are all smaller properties. And so that way we are just reinvesting refi dollars. Now, if we don't have a deal to put those into, we're going to distribute those back out to the partners. But yes, everybody participates in everything in their pro rata share of the percentage of ownership. Additionally, when we do distributions on that property as refi, 100% of the proceeds from a refinance would go directly to all the partners first, and we don't take as sponsors any part of those refi dollars out. Those will be going directly back to the partners if we don't reinvest them.
Okay, next question. Can you give us an update on the status of the Ridgemar sale, please?
Ridgemar sale, the first contract, they ended up delaying and delaying and delaying before we finally told them to take a hike. And then we turned around and went to a backup offer. So we've negotiated a contract on that, which is ready to be signed and move ahead with a more qualified buyer. So that is either under contract this week or next week.
Excellent. Next question. I think I'll take it, Darwin, if it's okay. It's question is, can Dar Corp benefit from the second bite of the PPP program? And please explain how you're going to take advantage of the new rental assistance program. Number one, in regards to the PPP program, we will not get a second bite at the apple of the PPP, and that's for a very good reason. In order to be eligible for the second bite at that apple, you have to show a 25% loss in any of your income for an entire quarter of 2020. And for those of you who were on our last month's webinar, when I gave the update, our properties did very well in 2020, given the circumstances. So no, we cannot have a second bite at the apple because we don't have the losses that are necessary in order to qualify. In regards to the the new CARES Act, as it's being called, and the rental assistance program, just real briefly, because it's kind of long drawn out. Actually, we just got news today that Texas as a whole has been approved for $1.3 billion in assistance and aid. To give you an idea how much money that is, the first go round of rental assistance under the first program was $140 million. So now we're talking about 1.3 billion. So we would believe that that would go much, much further than it did the first time around, which was still a huge help. And just so you know, we're being very proactive, as I spoke about on my previous webinar in January. We kind of have an idea of what they're going to ask and who's going to qualify and who's not going to qualify. And we started this process almost 30 days ago, where our properties, the staff at our properties, have already started the files. And when I say that, we've already started working with the tenants, getting their documentation in order to prove that they can or cannot qualify. We've already started putting together the leases and the tenant ledgers, all of the information, the ID. So we're 95% ready to go with our files. And we did that because, like most government programs, it's going to be a first come, first serve. We just found out today that it opens up next Monday. So as of Monday, the 15th of February, we will have the ability to either phone call applications or online applications. We'll certainly do online as long as we can get in. If not, we'll follow up every way possible. But just real quickly, understand that rental assistance program, it's going to be prioritized for those people first who are 50% or below the median income in the area in which the property is located. The next priority will be people that are at 80% or less median income in which the property is located. But it's really kind of caused some strange bedfellows here, and I was talking to several people about this today, because on one hand, understand that the way that it's currently written, the tenants really cannot apply on their own. They must have the help of their landlord. Now that's good news for us, because the payment, when the application is made, the payment, as long as that payment is going to be applied to rent payments and not other miscellaneous stuff, the payment will be made directly to the landlord as well. So that's good news for us. So really some good things out of it. The second part of that question was in regards to how does that affect the eviction moratorium? I can't answer that question. We don't really know, but we do have the ability under the new program to go back up to a full 11 months. So we can go back 9 months and we can go forward 2 months. So when we fill out these applications, and again, we've already been very proactive in getting our files together, we'll be hitting the ground running next Monday and sending in our applications for everyone, and hoping that we get a lot of that money back for our residents. How often will there be distributions for Blue Tahoe, monthly or quarterly, Darwin?
Well, when we do distributions, because it is a growth fund, we distribute cash flow monthly as we have that. However, there's a lot of value add to these. So, for example, when we buy a property, like the property we just bought, we raised rent 7.7%, hoping that some people will move out. And those units we can fix up and then raise the rents 30%. So we're planning on a year's progress to get all those turned out and have a lot of rent growth. Now, if they all stay and they all pay the 7.7%, then we can't really fix up the interiors more and we'll have cash flow faster. So we will be sending out distributions monthly, but don't count on this as a cash flow property. This is a growth fund where we're trying to dramatically increase your net worth on that project rather than provide cash flow per se. Now, there is a 7% preferred return that when there is distributions, the partners get this first 7% no matter what happens.
Okay, on the Blue Tahoe investment, are all of the properties on the California side, Nevada side, or a combination of the two?
It's going to be a combination of the two, but realistically, the majority of those properties are going to be in what's called South Lake Tahoe. South Lake Tahoe is there's State Line Boulevard, so Nevada is on part of it and California is on the other. Most of the apartments are on the California side of South Lake Tahoe. Now they're all around the lake, they're dispersed all around the lake, but the biggest concentration is in South Lake Tahoe on the California side.
Okay, to that same point, will Blue Tahoe income require paying California taxes on that income?
Unfortunately, yes, they will. You know how bad taxes are in California, but there's not because there's not a state income tax on your part of it because you live in Texas. There is going to be income tax based on the property in California.
Okay, and I think you touched on this, but our last question is, what is the projected hold time for investors in the Blue Tahoe investment fund?
We've got a 5-year horizon, just like we do on every properties. We budget out 5 years, but that could be 3 years, that could be 7 years. It all depends on what is going on with the market and with the economy and where we are. And again, our goal on that is to build up 300 or 400 units there so that we have control of the market. And at that point in time, it will be big enough for an institutional buyer to want to come in there and control that market. Whereas right now it's all mom and pops. So that way we can actually get a higher price for everything as a large portfolio in that area.
Okay, that's all the questions that we have, Darwin. Thanks for doing that. You got anything you want to close with before I close?
No, but I do want to go ahead. Actually, yes, I do. I want to thank everybody that are partners that trust us. We try and tell the good, the bad, and the ugly, communicate as effectively as possible. We send a ton of information out, and we have an open door policy for any questions, concerns, anything else, and anybody on the team can answer any question, and nobody has any restrictions on what they say. So you can talk to anybody and you should get the same exact information. And especially if you talk to Garrett and David right here on your screen smiling at you, they can get you plugged in, they can get you information, and we welcome everybody to ask as many questions as they want and to be involved as much as they can so that they understand what their investments are doing. We like having educated partners and want to keep you informed.
Thank you, Darwin. I'll close here and just remind everyone that we are recording this presentation. So this entire presentation will be available for you for your review. In fact, the first time you'll see it will be a link on the DGRE newsletter that goes out every Thursday. So you'll be able to access it there. If for some reason we don't have your email or you're not getting the DGRE newsletter or updates, please send our investor relations team. Let us know what email you would prefer, and we'll be glad to do that. Also want to make sure that everybody knows that we do send out a text every time we send out a distribution from the property. So I heard from somebody the other day said, I should be getting 6 or 7 of these. And I said, yes, you should. But we don't have a phone number for you. So if we have a phone number, we'll be glad to put that in. Please understand we don't share your email or phone number with anyone. That is absolutely secure with us. We're not sharing that with anybody, but we do want to keep you as updated as we possibly can. So having said that, we'd like to thank Nate again for his time and expertise, and like to thank each of you for attending tonight's meeting. We know that you have a choice on who you trust with your money. We feel very honored, and we do know it's an awesome responsibility that you trust us. Nate has provided his contact information, so we encourage you to reach out to him for your specific needs. And again, this entire recording and presentation will be recorded and made available to you. And then lastly, please reach out to the DGRE Investor Relations. As Darwin said, you see David and Garrett there smiling at you. Reach out with any questions or any information about DGRE, or certainly the 2 opportunities that we discussed tonight. So again, thank you all. We very much appreciate it, and we'll talk again soon. Thank you.